In paper P2, a key standard always emphasized by the examiner is FRS 36. FRS 36 refers to impairment of assets. This should not be confused with revaluation of asset. Revaluation of asset is always due to market value going up or down, whereas impairment of asset, there's only one way, that is down. And it is a permanent decrease in asset value. Why does an asset fall in value permanently? It is due to obsolete asset, technological progress which has made the asset become obsolete, damaged asset which is underused, underusage of the asset due to decreased demand for the product produced by the asset. All these are indications of impairment where the company must go and run an impairment test. And when you run an impairment test, we always compare carrying value of the asset with something called the recoverable amount. And the critical word in FRS 36 is recoverable amount. Recoverable amount is always the higher of value in use, which is VIU, or fair value less cost to sell. What is VIU? A value in use refers to cash flow generated from continuing the use of the asset until the end of its life. Take these cash flows, discounted at pre-tax market interest rate will result in VIU. This must be compared with the fair value less cost to sell, which is obviously the price you can sell the asset minus any selling cost. Choose whichever is higher and fit it into recoverable amount. Then you take this recoverable amount and compare with the statement of financial position carrying value. If the carrying value is greater than the recoverable amount, then we have an impairment loss. And impairment loss is widespread into many areas in accounting. One of the areas where we use impairment asset is obviously fixed asset or tangible asset. We also use impairment rules in intangible asset. We also apply impairment rules into goodwill and also into financial instruments nowadays. And everywhere you go later in the syllabus, you'll be seeing impairment. Therefore, it has become a widespread area in the subject, please. Also, at the same time, if the carrying value is greater than recoverable amount, we should bring the asset down to recoverable amount. What if the carrying value is lower than the recoverable amount? If carrying value is lower than the recoverable amount, then we need to check for reversal of impairment loss done previously. Obviously, the easiest thing to do would be say there is no impairment. But once you say there is no impairment, kindly check whether this asset has been previously impaired. If this asset has been previously impaired and now the carrying value is lower than the recoverable amount, then there's a necessity to check for reversal of impairment loss. How do we check for reversal of impairment loss? Reversal is always based on depreciated historical cost and not recoverable amount. So never reverse based on recoverable amount. For reversal, you must take depreciated historical cost, compare it again with the carrying value in your statement of financial position after the impairment. If depreciated historical cost is greater than the carrying value after impairment, you will need to reverse it and bring it back to the historical cost. In doing so, the maximum reversal is determined by depreciated historical cost and not recoverable amount. And whenever you do this reversal, we must assume that impairment was not done previously. If it was not done previously, historical cost would have been maintained. So the logic of using historical cost is, if there was no previous impairment, historical cost is the best basis for comparison, and reversal applies this principle.